So our next speaker is, well, the theme, of course, is the local investing and income and growth scheme. And our next speaker is actually me. So without any further ado, let me introduce you to a man who I really admire, Peter Switzer. This is kind of interesting, and the reason is that, you know, Sean Burns is here, and Sean will speak later about another fund that he manages for us. But I thought this year maybe I should talk about the fund for a variety of reasons. A, to give Sean a break, but also I just wanted to talk to you about, you know, my experience with the fund and where it all came from. I think understanding where a fund comes from and what's the intent of the person who created it is a really important thing. It tells you whether you really want to relate to that fund and to the people who are running it. Ironically, Richo was the guy who actually inspired, I left the word out this, but inspired by a politician. I had him on my television program, must have been 3 or 4 years ago, and I just asked him off the cuff, I said, you know, do you invest in the market? And I was asking him about political questions at the time. But I said, do you invest? And of course, he said to me, well, I don't have to because I've got a fabulously fantastic politician superannuation fund. He said, but I've got money, spare money, so I've got a self-managed super fund. And I said, well, what are you invested in? And being a straight-up kind of guy, he just said, and I said, how have you been doing? He said, really well, really well. I said, well, what are you invested in? He said, I've got 5 stocks, the 4 banks, and Telstra. And he was, at the time, he was killing them, but they were all doing brilliantly well. Nothing was getting in the way of those 5 stocks. And I just said to him, Richo, you've got concentration risk there. And like a normal person, he said, well, what's going to happen to the banks? You know, well, his good mate Bill Shorten did something to the banks by pushing for a royal commission for starters. But Telstra, of course, had its problems as well. So it was on that, when he gave me that answer, I realised that a lot of people in this room may well be in that sort of situation in one stage in life. And I said, well, what I need to do is create a fund that specialises in chasing yield. And it'd be nice to get a bit of capital growth, but I think the most important thing for some people, even if there's a core of their portfolio, is to make sure you get yield. Now, at that point in time, term deposits were falling. And I've got to say, Donald Trump has actually helped as well, because Donald and his trade war has, in a sense, made the Fed cut interest rates, and everyone's cutting interest rates, and that, of course, has led to this chart here, which talks about the 1-year term deposit rate versus inflation. Now, you look at that there, the brown curve is the 1-year term deposit. Do we remember the days when it used to be 12%? Hands up those people who'd love those days again. Of course, inflation was really high. Our real gain was only probably about 3 or 4% because inflation was about 10. But certainly I knew that people like Richo were in those 5 stocks because they wanted yield, they wanted income. And once upon a time, term deposits gave you a reasonable return if you ignored the inflation that prevailed at the time. And so that's why I got together with the guys at Contango and said, let's create a fund where a professional guy who understands dividend paying companies goes off and chases, say, 30 good companies that most normal people wouldn't necessarily know. And of course, the ones you do know are in the fund. They have to be the banks and Telstra and whatever. But there are a lot of really smaller companies that had a good history of paying dividends. And my philosophy, and it's the way I run my own self-managed super fund, is I have designed my super funds so they're heavily inclined towards paying dividends. And the reason is, even though I do take brilliant advice from myself, I could miss the next crash. But as long as that the stocks I've got keep paying really good dividends, if I was totally retired, the way I've designed it is the income that I would get would pretty well consistently return exactly what I want. So I can live with my capital going. And now I know a lot of people in this room would never accept their capital going down. But in being like that, it means that you leave yourself at risk to capital loss. You search for capital gain, but you can lose capital loss. And one of the best investors I've ever known retired with $5 million in his super. He always bought dividend-paying stocks during crashes of the market. That's when he bought. He was an ex-fund manager. He'd buy it during a crash. So he got CBA at $27. He now has a yield of 16 to 18% with franking credits because he bought CBA at $27. And when he retired, he had an average yield of 10% on his portfolio on $5 million. So that poor bloke had to live on $500,000 a year. And in the year when the year that the market 2009 really went against him, he said, I decided to spend 9 months in France rather than 6 months, and on a high Aussie dollar of $1.10. That's the kind of way he had designed his portfolio of assets. And that's why I wanted SWTZ to do, for those people who couldn't select it for themselves, this would be like a one, like go in and buy. Now, of course, as a financial advisor, I would never advise you to be in one. I have a whole lot of different ones that do the same kind of thing if you're searching for income. So, outlook for dividend investing, with all the stuff that's going on in the world, I can't see interest rates going up. There's talk of recessions, even though I don't think it's imminent. Government policies aren't going to help interest rates go through the roof. We've got trade wars and Brexit and the whole behaviour of the EU. They'll be cutting interest rates soon. So we know that we're going to be in a low interest rate environment for quite some time. Now, with the Switzer Dividend Growth Fund, this is what basically I've told Sean Burns to do. Target yield, go looking for companies with quality balance sheets and cash flows, and go after those companies that have high yield but can have some growth. That's basically the order. And so this is what basically has happened since inception. We came on the market, what was it, February 2017, Marty, was it? February 2017. And this has been the basic story. So there's the yield there, $2.59 at that time, 7.9% net, grossed up 11.2%. But like even Sean said to me the other day, the last year was extraordinary, but it was an extraordinary year. You know, there were special dividends, like mining companies now are good for dividends. They were extraordinary years. What we basically wanted this fund to do was do around 5 or 6%. 5, I'm happy, whack on the franking credits, and we're in the 7% area. And that, I think, is what a lot of people really want as a core. And then they, might buy the Switzer report for some alpha investments, buy some of the great funds that have been mentioned here today. That could be in their satellite investments. But at the core, you want something, particularly if you're over 60, it keeps consistently returning income. I asked one of the guys there to give us an idea of how we did against Richo's stock. And it looks pretty crazy, but the green line is Telstra, the red line's Westpac, NAB's a red one as well, ANZ's kind of an orange, the colours could be better, CBA is yellowy-orange, and Switzer's the blue one. And as you can see, given what we tried to do over that period of time, it pretty well has beaten the collection of those stocks that we're up against. And I also say, there are other funds out there that did better, but this is what I wanted my fund to do, and it's pretty well delivered. And so if you sort of sum up the characteristics of SWTZ, that's the story. The net distribution yield since inception is 5.9%. You have to add on franking credits if you want to gross that. Gross distribution yield, 8.2%. And here's all the other stuff there. And it's nice to compare against a term deposit of 1.5%. And this is the very attractive investment team. Myself, Paul Rickard, and Charlie Aiken. Look, I do have a great belief that when it comes to money, I really do want people either with no hair or grey hair. And I've got to say, Charlie does lower the average age of our investment committee. I'm going to have to look for another older person, probably an older woman, of course, as well, so we make less dumb decisions as well. So in conclusion, the SWTZ provides diversification from the mum and dad index. The mum and dad index is basically those 5 stocks. That's what a lot of people call. By the way, we once had an offensive phone call from one of our subscribers who hated the idea of us referring to non-professional investors, mum and dad investors. So if you're offended by that, I apologise, okay? Delivering an objective high frank yield paid quarterly at 11.2%, there you go. Important part of a diversified portfolio. Designed as a core holding of the Aussie equities portfolio, and that sits. I was really happy when the ASX allowed us to have my nickname, Switzer, as our ticker code. That was actually very nice of the ASX. And ladies and gentlemen, that's basically the story of Switzer. That's what we tried to do, and I think the environment and the timing of it was right. I never thought we would see dividends so big, particularly from companies like BHP and Rio, but that's just the environment we're living in, and I'm really happy that the fund we created actually fits the right time. Thanks very much. Okay.